don't think that Barry Sternlicht needs much of an introduction, but let me start by saying the following. I think that, I've interviewed a bunch of people over the past 10 years at this, including John Gray and Mike Fascitelli. But in addition to being one of our titans of the industry, I think Barry has one of the more unique views from the lens of many different parts of the industry, and especially at this time in the cycle. I mean, if you watch CNBC, he's on almost as much as Becky Quick. And I think that, we've heard him a lot, and we'll get to the favorite topic he has on interest rates. But before we get there, I just want to sort of go back, because there's a lot of young people in the audience, and Barry's been in business a while, not as long as me, but it's been a while. And after Brown and a Harvard MBA and JMB, which I guess is the equivalent of working for Nick Saban at Alabama, the people who come out of that organization. 1991, you started Starwood. That was the first of many cycles where, I guess in hindsight, you would say property was really cheap, if not free. With Bob Faith, you started the company. And I guess what I would ask is, when you think about 1991 and you think about 2009 and you think about the pandemic and you think about today, and if you look forward today, how would you compare where we are moving into potential recession, et cetera?
Can everyone hear me? Hi, Jimmy.
Barry.
Thanks for having me. I was 31 when I started Starwood, and we started with $21 million, 10 each from two families, and $1 million from my old boss, Neil Bloom at JMB. I start every marketing book for our firms. Today we're a $125 billion asset manager, so we've grown a little bit. But there are three green lights in real estate, or three lights that are important. And the first is positive leverage. When you go negative leverage, there should be a flashing yellow light on your dashboard. And right now, at least in the United States, Europe, it's negative. It's negative leverage for most every asset class. So that is a warning sign, like be careful. When you have positive leverage in growth countries like the United States, eventually you'll get paid to hold the real estate, and eventually growth could bail you out. So that's one. That's now flashing dark orange, may even be red. The second one is buy below replacement cost. And that's important because you could have positive leverage, but if you're paying $1,000 a foot for a building that costs $500 a foot to build, people will come in and keep building and arbitrage the gap away, and you'll pretty soon have 35 new projects underway, and rents will come down, and you'll soon have negative leverage because rates will fall. So it'll induce new supply. And you're protected. On the other hand, if you buy below replacement cost, rents have to rise in order to induce new supply, right? Or nothing ever gets built. And back in 91, we were buying apartments. We bought, the first deal I ever did, Windmill Apartments in Colorado Springs, we bought 300 units for $5 million. It was $15,000 an apartment. I think that was like the cost of the asphalt in the parking lot. So we got everything for free, basically. And you had no competition. Everyone was in complete shock from the fall of the S&L crisis.
It was just Goldman and Jay Roberts, right?
Yeah, they weren't even started. We started before them. There was no one there. We went to cow fields and bid in open try auctions with the government selling loan pools literally in fields in Iowa, playing music between sets. It was a cartoon, actually. But the same thing happened coming out of the 07-08 crisis. We bought a portfolio of loans from Chorus Bank, and we were heavily criticized by a presenter in this conference for overpaying. It was a $6 billion pool of loans on 100 projects. The debt, the original construction costs, well, I guess the total construction cost was $6 billion. It was like a $4 billion pool of loans, and we paid $2.1 billion for it. So we're in at 30 cents on the dollar. We bought brand new apartment buildings, basically in Denver, here in New York City. And then the government gave us 70% financing at 0%. And everyone thought we were insane. And we tripled the money in like 2 years. And there was no other bidder, the related bid, and they were the ones who criticized our bid, very openly in front of 5,000 people in the conference in Arizona. So I thought we definitely got the last laugh about that. I think Steve owes me a dinner. So the second one is construction, buy below cost of construction. And the third one, I'm trying to remember, the third one was, I forgot. I'm tired. Supply? Oh, well, I think obviously supply is pay attention to supply. I don't think that's it, Michael. So anyway, yeah, it is new supply. Obviously, if you buy below replacement cost and you have positive leverage, but there's tons of new supply, rents could fall. And so you could find yourself with negative leverage pretty soon. Supply at the moment is probably relatively green light in certain asset classes and a flashing yellow in others. Sometimes apartment markets today, there's a total of 800,000 units in the pipeline for apartments. That's a big warning sign for apartments, but that's market by market. They're building in the best markets, and if you're in Albany, you're probably safe. But if you're in Charlotte, there's a lot of construction. So those are the three baselines. Real estate is sort of, I always said, the most practical application of common sense there is. Sometimes, sadly, in real estate, there's not that much common sense. And one of the things you see people do is, well, I'm building the best building, so it doesn't matter what else is happening in town, or I'm building the best hotel, so it doesn't matter that there's 20 other hotels going up. It all matters. So when you build, even if you build Hampton Inns and you build 60 of them in New York, and you own the St. Regis, they're gonna take market share from the Crown Plaza, is going to take market share from the West, and is going to take market share from the JW Marriott, who's going to compete against it. New supply does affect you in asset classes, and new always wins. So supply is a big issue. So I think those are the and so you ask, like today, we're in the beginning of a cycle, of a distress cycle. Every time we invert into these rapid change markets, it would be the GFC that happened in 07, 08. Some of you were probably in grade school. It was I have to remember, it was like 13, 14 years ago. You might have been, if you're in college now, you could have been 4. The world was ending. It looked worse than this in some ways. The whole banking system, looked like it was on the verge of collapsing. But the government came to the rescue. They lowered rates to 0 and pumped new life and suspended the mark-to-market rules for banks, allowing them to recapitalize. They had deposits and they were borrowing at 0, so they would recapitalize. It just took time. And they did, and then they started selling loans. But in the beginning of the cycle, in 09, there was nothing to buy. Like the world collapsed in 08. Nobody would sell anything in 09. The banks couldn't sell stuff and take the losses. And the government said, you don't have to take the loss. You don't have to mark to market. So they sat on stuff, and eventually the velocity of deals picked up. Today, you have wide bid-ask spreads, and the only person who would sell today is if you have to sell.
Well, it's early, right? There's no capitulation yet.
You're early.
You bought a 1-year cap.
I want the price I could have gotten literally 6 months ago, and somebody wants to pay me the price that reflects today's interest rates and the spreads they're paying on the debt. So the transaction volumes are drying up. Having said that, the dam will burst, because if you had, and this is where luck comes into every career and every fund. If you had a 2018 vintage fund or 2016, you had a 7-year hold, you probably, 2018, you put a 5-year loan on. That loan is maturing in 23. You don't really want a loan maturing in 23. If your loan was maturing in 26, you probably are going to be fine, because I think rates will be lower, and we'll get into that. But that's just a function of when you did the deal and what you thought. A 5-year hold would be a normal hold for a fund, and you're going to have an issue. Can you sell the property accretively to what you paid for it? And the sad part about what the Fed is doing, I kind of like when they shake, when the trees are shaking, the stupid deals that you think are stupid become really stupid and they go bankrupt. And the good deals shine and you feel like you were smart. With what the Fed is doing, they're literally emptying the ocean of water. Everything dies. All the fish die. The healthy blue whale and the sick little creature that should have died and was going to die on its own. Everything is in trouble. There's no piece of real estate in the United States, anywhere in the world, that could probably be worth what it was worth 6 months ago. And to tell you how screwed up the Fed is, these same geniuses, in December of last year, they predicted Fed funds for this December, for today, at 0.66. They're only off by 400%. So like, they don't know what they're doing, and I'm 100% confident what they're doing is not correct right now. 100%. Not even 90. I don't think I've ever been 100% I'm 62, in my entire life. This is the first time I can tell you with 100% conviction they're wrong.
Don't you think to some extent the problem is going to be the wage growth and the target of 2%, which is probably a silly target for inflation because so many people left the workforce that it's almost going to be impossible. I mean, I saw California, the state of California yesterday was giving these big raises to the employees. If the Fed goes purely on wage growth, they're going to continue to raise rates, right? I mean, trying to get
100%, and you want wage growth. Like, and that's why I have such a problem with what they're doing. It's very simple. It's not hard. There was all this money, trillions of dollars, $6 trillion here, 12 trillion in the world, printed and handed to consumers. And we wanted to buy stuff, and we couldn't get it. There was a supply backlog. You couldn't get your couch, you couldn't buy it. You had nothing to do but shop, and you shopped. Too much money chasing too few goods is inflation. We just had that. It had a little delay to it. Now, the savings rate has gone from 33 to 2.6%. And if you look at credit cards, they're going vertical. My house manager in Miami, his brother called him last week and said, I want to buy something, can I use your credit card? He said, why can't you use yours? He said, it's maxed out. That is happening all over the country. Just look at the data. It's all there. Vertical growth in consumer lending on their credit cards. Americans are out of money. Now there's no money and there's too many goods. Look at inventories. They're literally sky high. All the retailers, all the suppliers, seeing the pandemic surge, went out and ordered everything they could order, and it's sitting on shelves, and they just discounted the shit out of it during Cyber Monday and Black Friday. And sales were good because they discounted heavily. Almost everything was sold at a discount. And they're going to keep the discounts through the end of the year because they have to clear these inventories. And that's what the data shows. So my problem with the Fed is the economy was rolling over on its own. The consumer is out of money. The only issue that he's fixated on is employment. And it's going to be hard to kill employment without killing like you're going to kill, the patient's going to die with the remedy they've selected. And the reason that's going to happen is that they really are looking at killing job growth. And I keep telling them to clear the 1.8 million worker visas that are sitting on the desks of Washington. That number used to be 400,000. You want to get we just hired somebody from Norway. We couldn't get them in the country. It takes 12, 14 months to get them in the country now, up from 3 months. It's insane. Like, you want to reduce wage growth, let people who want to work here. And the Biden administration is, by the way, Trump was no genius, but there was only 1 million. This is 1.8 million. It's their numbers. I'm not making this up. These are facts. They're facts. Immigration is down to 200,000 people. We haven't had an immigration that low like in 50 years. That's legal immigration. I don't know what's happening at the border. Like, why don't we let people in the country? Why don't we reverse HB1 visas? Like, let us hire foreign workers. Let us keep the students who are actually going to school here. We can't keep you. We want to hire you and we can't keep you. How stupid is this government? So it's ridiculous. I mean, these are educated people. We actually educate them in our higher institutions. So there's a lot of self-inflicted stupidity going on.
Well, I heard you say that now that we have a split Congress, gridlock is good, they won't do stupid things. I think that was your quote.
Less stupid things.
Less stupid things, right.
Leave it to politicians. I mean, next question.
Yeah, so I want to talk about the hotels for a second. You were one of the leading hotel buyers, whether it was,
By the way, it's not funny. I mean, it's a competitive world. And with Congress focusing on Hunter Biden and what happened in who cares? These aren't issues that are the future of this country. And the biggest problem we have is our education system. And you're seeing the result of a failed public school education system today in the United States. I went to public high school. People don't want to send their kids to public high schools anymore. And you can't, I'm chairman of the board of Robin Hood, and I've been on Robin Hood's board, I think, for 22 years. You want to cry when you see how hard it is to improve kids' education in cities like New York. And it's not because of money, it's because of the disincentives in the union structure. So, nobody cares about the kids. It isn't about the kids, it's about the teachers working as little as they can with no standards, for the least amount of hours with the highest pay. That's what the teachers union stands for. You're getting what it stands for. There's nobody representing the children.
Yeah.
And we're seeing it. It's paying out. Like, if they're not educated, they can't get jobs. Certainly in this economy.
Barry, you bought Weston, you bought Sheridan, and then you did a deal with Marriott, and then you did the W. But recently you bought the One. With Left Rack, you converted the One, and you did the Standard recently.
No, I created the One.
Great.
I didn't buy it.
Right.
I created W, and then I created the One brand.
Is this more about Miami or more about hotels when you look now going forward?
No, I mean, look, hotels, I love, the thing I love most about real estate is architecture and design. So for me, my outlet for creativity is hotels. And when I created Starwood Hotels, I was friends with Ian Schrager. I saw his hotels in New York. I thought they were cool, but nobody had done them at a scale level. Nobody thought you could do a chain boutique. They thought, in fact, I'll never forget the first W on Lexington Avenue. I walked it with an analyst from Prudential, whose name I will spare. And he walked through there with me. He goes, so what are you going to do when W fails? I'm like, it's not going to fail. And today it's probably the most successful new brand of its type in the world. So One Hotels was built, I was going to do another hotel company. I did W in a public company, Starwood Hotels, which was sold to Marriott. And I decided Starwood Capital was going to do, I wanted to do another hotel brand, but I wanted to do something that mattered. And I was friends with Blake Mikowski, who had Tom's Shoes. And they gave away a pair of shoes for every pair of shoes they sold. And I thought, my kids were at school, and they were all into the environment. And I was also, I think there were a lot of really, Howard Schultz saw the baristas in Italy and imported it to the United States, and that became Starbucks. I was really cognizant that the Europeans were way ahead of us on sustainability, but I thought we would get there, and we'd care. So I decided I'd teach people they could live a luxurious life and yet a greener life. And so I launched One Hotels. One Hotels is it's one world. One world, we're all responsible for each other. When they burn coal in China, crosses the atmosphere and screws up the snowfall in California. So One Hotels is 7 or 8 hotels open, probably 30 in the pipeline. And from Tokyo to Melbourne, China, Riyadh, all over the world. London will open in April, Paris probably 2 years later, Copenhagen. And then we just opened in San Francisco, Toronto, Nashville. We're in here, New York, Brooklyn, Miami. Miami was the first by accident. Richard was he had 25% of the property, we had 50, and Invesco was the other 25. So I was responsible for the brand's creation and design. And it's done really well. It's killing it, actually. So the hotels are outperforming every brand, every major brand in every city they operate. And it proves that if you can build a good product, a differentiated product, you can price to that. And if you have an emotional content to a brand, if it stands for something, JP Morgan, Google, Microsoft, they all want to book the Brooklyn One Hotel because they want to brand themselves as caring about the environment. And my fight is to keep the hotels green. It's really hard because people cheat. And you need like a brand police because everybody wants to cut corners. So when I go there, like, who ordered this vinyl replacement carpet? It's clearly not green, and I don't know where they got it from, but it was expeditious because they had to put some new flooring down, and it's the wrong flooring. So we also have, in that company, which we call SH Hotels, it's our own management company. It manages the Baccarat brands. We built the Baccarat here on 53rd Street, and also a new cute brand called Treehouse. And Treehouse is operating in London, soon in Manchester, in Sunnyvale, Miami. We're going to do a Treehouse. So Treehouse is kind of an ace with it's more fun. It's sort of a cheaper version of a One, but it's just fun. Because I always thought as a Treehouse, I've had this brand for like 15 years, and I never had time to execute it. But it's like you're a kid, you want to play in your treehouse, and you play with that doll that doesn't have an arm, or the broken train, but you have an imaginary world that's fun. I wanted to get adults to have a chance to get back to having fun and just enjoying themselves in a hotel. So it's branded around fun. And we literally go to like the flea markets and buy stuff, and that's what you see in the rooms. So it's supposed to, and it's fun. I like that. It's fun. It gives me, it's like my therapy in a world of rising interest rates, which is not fun for real estate.
So Barry, if there's distress in the marketplace, you're going to see it first because you own L&R, which is, I think, the largest special servicer in the country. Are you starting to see borrowers come, you put them on the watch list, you're talking preliminarily
Again,
about.
for the students, we'll explain this. So every CMBS security, every commercial mortgage-backed security that's sold, it's usually the loans are pooled together. I see Mr. Lehrman here, he's a pro at this. Pulled together and sold to investors in a commercial mortgage-backed security. Whoever the bank is usually becomes the servicer. They call them the master servicer. They're in charge of collecting the rents from everybody and dispersing the payments to everybody. If a loan gets in trouble, it's handed from, it's in the document, it's passed from the master servicer to a special servicer. And his job is to work it out and try to protect the bondholders. L&R, which is part of our public company, Starwood Property Trust, is the largest special servicer in the United States. It's named servicer on $100 billion of loans. So if they get into trouble, we will see $100 billion of assets pass into this pool. This company is based in Miami, where I spend my winters. And right now, I think we have about $8 billion that's passed, that's actually named, meaning we're in the document when Lehrman does the securitization, and they've actually given us the loan. And yes, it's probably double the amount.
How much is that his office?
I don't know the answer to that, but probably half. And it's going to be a lot higher. So, I mean, half of me is upset. For everything I own, I'm not happy with the Fed because it's indiscriminate death. Half of me is happy because there are going to be amazing opportunities to deploy capital today. And I think your first goal should be to find great assets that have a bad balance sheet, right? That's the easiest thing to fix. Fixing an asset that's broken takes a lot of work, but if the mistake of the asset is the guy borrowed incorrectly and needs a new capital structure, that's easy for players like us to fix. So, we have a $10 billion, this is our 12th global opportunity fund. This is $10 billion. We've deployed roughly half of it. We have $5 billion of dry powder. And we've been we haven't done much. We're doing a transaction right now in Asia of scale, but we haven't done much in the United States because, frankly, we're sort of scratching our heads about what the shape of this recovery is going to look like, the depth of the recession that I think is going to happen. And it's not an issue it's an issue of timing. When do you go in? And obviously financing anything today is absurd. I mean, so the opportunities at the moment are in the debt. We were trying to raise debt funds, frankly, because you're writing first mortgages at 9 and 10%. That'll be spectacularly beautiful pieces of paper if I'm right about rates and rates come down. So the debt markets are unbelievably attractive. I mean, it's ridiculous. We sold a company for $2.2 billion in August, and the security, the debt, the CMBS was $1.1 billion. The company makes $200 million. The AAA was $700 million. So and the coupon was interest rates were I'm guessing they were 4. The SOFR probably was lower at the time, but the spread, the AAA priced at 260 over SOFR. So at 4 today, that's 660 for a AAA security. That's let's say we'll round to 7% on 700 million. It's $49 million of debt service. There's $200 million of cash flow, right? That's like put in your kid's trust, back up the truck, sleep really well, put a little bit of leverage on it, earn an 8. And you've heard every endowment's hurdle in the United States. Every single endowment in the nation wants an 8. And you're taking virtually no risk. That's ridiculous. And what's ridiculous is the 260 spread for AAA. In a normal market, that would be 80, 75. So that's tripled or quadrupled in that case. That's ridiculous. That's an opportunity for people to pounce on paper like that and stuff their mattresses with paper like that. That's ridiculous. You can't get stupid rich. You're definitely going to earn some money while you're waiting for the world to get better. And it's fascinating because we bought all the junior securities, all of them. It's like they were like, this is the best thing I've ever seen. So we happen to know the company really well because we owned it for 10 years. So very stable, very diversified, and a very good company. So it's very interesting times. Again, it's what's bad for you as an owner is good for you as a buyer. So
let's talk about, for a second, the non-traded REIT business. The good news for a long time is that you and Blackstone owed 90% of the market. KKR,
93.
Oaktree, Brookfield, Ares, Black Creek, they owned a smaller piece. And now, you're facing the potential of redemptions, of course, and there are redemptions. But I think the audience maybe doesn't really understand the implications of why you have to do what you have to do in the non-traded REIT sector. And why don't you just sort of go into that?
Okay, again, for everyone's benefit, the non-traded REITs, this is 2.0. There was a 1.0. Most of us passed. 1.0, the load, mom and dad invested through their Merrill Lynch, UBS. In those cases, none of the wire firms played in that, the big wire houses. They raised money through LPL Financial and the smaller Ameriprise, smaller groups. And there was a huge load, like 18 points being paid to brokers to raise the money. And we all avoided, Blackstone, us, and others, I think, avoided 1.0 because it was putting 82 cents to work for a client. We couldn't figure out how it was a good deal for them. Up comes 2.0, and the load is de minimis, probably 2 or 3%. It's not that big a load. And the fees are lower. And the industry was born because we could pay in the beginning 5.5% dividends when the public REITs were 3s and cash was getting 0. These things grew like water. I mean, we and Blackstone, they're about, we're 30 billion and they're 130 billion, so that's 4 point something times us. We raised a lot of money every month from mom and dads through the major wirehouses. And we both have big brand names. They have a much bigger footprint than we do. And we weren't sure how much money we wanted to raise because we had to put it out. And we were worried about the opportunity set to put the money out. So we never got too big in Asia or Europe on purpose, because if we were raising $1 billion a month, that means we had to buy $4 billion of property a month. And there simply weren't that much stuff for sale. But we all did really well. Last year, our S-REIT returned 26% net to the LPs. We were aiming for 10s. The reason that happened is we both bought similar asset classes. We both bought concentrated industrial and multis. And those two are the best asset classes right now.
And you all fixed rates, right?
And we all, either through swaps or caps, we fixed our debt. So we're very comfortable paying our dividends. The NAVs, the net asset values of these companies, rose. So their dividend, I think, is like a 4.3, and ours is like a 4.5, or maybe it's a 4.4 and 4.5. Don't quote me on that. But they're lower than the initial dividend yields. Now, so what's happened this year is the non-traded REITs pretty much are all up. And actually, we're probably 5th in return, and Blackstone's 6th this year. And KKR and a few others are like double digit, 12, 13, 14, 15. I'm not going to speak to them because I don't know exactly what they're doing. But the market doesn't understand where our returns were generated from. So this year, these caps, and in Blackstone's case, they're fixed debt, we have to mark the value of the debt to market monthly. It's required. It's a GAAP principle. We didn't want to do it, but we have to do it. So roughly half our return has been the movement of the value of our caps. We have 1% caps in place. And LIBOR is, SOFR is 4, on its way to 4.5, it looks like. And so those caps are worth a fortune, right? And so half of our gain this year is the caps, the value of the caps. On the other hand, until recently, rents have been going like this in multis and like that in industrial, like 20% rent growth. So the other half of our return is our dividend, which is 4.5%. So 4% from the gain on the debt, 4% from the 4.5% from the dividend. What's happening? Rents are going like this, but we've been moving our cap rates up because interest rates are going up. So property gains are flat. So all this nonsense you read about, it's complete nonsense. These. Now, okay, how can S-REIT and B-REIT be up 8 and 9 or 9 and 10 when the publics are down 30? Camden's down 25, 30%. Well, here's how. That's not NAV. That's not fair market value. That's not a clearing price. If I want to buy Camden properties, I can't buy it at its current price. The board won't sell it to me. They'll sell it to me at whatever cap rate they think is fair value. It's not the current trading price. The difference between non-traded REITs and public REITs is we hug NAV. We publish the NAV every month. And there's a third-party firm called Altus, and they review all these valuations and say, this is the valuation. You negotiate slightly with them. But there's every quarter, there's about 25, 30% of the portfolio that is third-party appraised. So this thing is meant to hug. It's supposed to not be as volatile as the publics. The publics can go, I remember when I was trying to buy EOP and I was working with Steve Roth, his stock was trading at a 3 or 4 yield. Like it was the multiple, they were trading at huge multiples to NAV. These things will never go to huge premiums to NAV, and they'll never go to huge discounts to NAV. And that's the beauty for the investor, is they get the yield and they get liquidity, but it's partial liquidity. They all got sold with the following provisions. We can cap redemptions at 2% of NAV a month and 5% a quarter. And that's what just happened. Blackstone said, we're capping our redemptions at 2%. Now, why is that? We're not a hedge fund. We own property. We can't liquidate our properties overnight talk about attractive prices, right? We have to sell you our apartments in 1 minute. Like, that's not the way it works. So we have to manage liquidity. And the government, the SEC, has actually said you have to keep to your caps. You can't be arbitrary about this. You can't pay out 3% 1 month and 0.5% the next month, and then 1% the next month. So in conversations with the SEC, they said, do what you told the public you would do, what's in your documents that you've been selling for the last 3 years. 2, and if necessary, 5% a quarter. That's all they did. It isn't a run on the bank. This isn't FTX. There's a huge, giant asset base behind these companies. There's properties, you can see pictures of them, there's cash flows, there's caps, it's all disclosed. So it's not what the press is, oh my God, it's like the end of the world. It's not the end of the world. What's happened is people actually think, okay, it's up 10, nothing else I own is up 10, I'll get out. Or maybe they think that, and they're probably right, that values will be challenged, right? Because, if interest rates go down, the value of our caps will go down. So it's kind of like a catch-22. Yeah, the caps will mark instantly to the new curve. The fixed rate debt will mark to the new curve, but that should take pressure off the increase in cap rates if rates fall, but they may not be at the exact same time. So it's a very complicated thing. These are pretty sound vehicles, and they will bounce around. Now, if I told you I have a family office, and if my hedge fund was up 7 this year, I go up and kiss them. I have a lot of hedge funds down 50, 60, things like Tiger Global, like not D1, Co2 is down 20, Dan Loeb is down 21. We're talking about, okay, we're down 3%. Oh my God, like a run for the hills. So, we're not down 3%. I said if we drop 3%, it's not that we're up 7 instead of 10 or up 12 instead of 15. People should be pretty happy. These aren't meant to be like, they're doing what they're functioned to do, what they're set out to do. And we will do what we have to do to create the liquidity. That we all have pools of liquidity. We'd like to manage it for the interests of all the shareholders. So when you redeem from a hedge fund, you do not get your money overnight either. Many hedge funds will redeem, whether they'll have a 1-year redemption period or 2 years. They will redeem you over time. It depends what they own. If these guys own privates in their public REIT, they would take them a lot longer to get you fully redeemed. So there's no difference between the non-traded REITs and the way the hedge funds operate.
So let's look ahead 24 months. A year ago, life science, the whole healthcare sector, senior housing, medical office buildings, life science was hot, especially in markets like Boston and Northern California, and San Diego and Raleigh.
Still hot.
What's that?
Still hot.
Yeah, so when you look out 24 months, what do you think you'll be buying and where?
Partly what you buy is what investors want to see. Right now, digital real estate is the flavor of the month, whether it's data centers. And it's kind of funny because until recently, rents didn't go up in data centers. But if you looked at Equinix, talk about an overvalued stock, it was trading at like a 3 yield, 2.5, 3 cap rate with no growth. A complete anomaly why it should trade there. There was no growth in rents over 4 years. But everybody wanted to be in digital real estate, and they probably didn't seem to care. And they were buying enough stuff because everything you buy is accretive when you're trading at 50 times earnings, 50 times cash flow. So actually right now you're beginning to see some rent growth in the data center world. And whether it's fiber, data centers, and you also have crossover players, you have very giant infrastructure funds that are moving into real estate, but coming at it from the infrastructure side. So they call data center infrastructure or the guts of a data center. Life sciences are interesting. Again, everything in real estate is market by market. We did a deal in Raleigh. We bought a piece of crappy building. We renovated it, leased it, flipped it. 18 months, had a 70 IRR, made 3 times our money. We are talking about debt. We bought the land next door to do the same thing right over again. We were building our first building. We have multiple tenants that want the building. And the debt, the only quote we could get for debt was from an insurance company. It was 65% loan of construction cost at SOFR plus 450, guaranteed by the $10 billion fund. That's a 9% first mortgage. Like, I want the mortgage. Forget about the project. I want the debt. I want to put it in my kid's trust. So that's why the debt is so interesting to me today. And I started Starwood Property Trust in 2009 as a blind pool. Jack's here. I mean, Deutsche Bank was the lead for us. They're the only bank that would take us public in the beginning. Then the other banks signed on. We had started what today is called iStar. It was once called Starwood Financial, so I did this once before. But we didn't really have a management team, but I knew the opportunities were as a lender. So Deutsche Bank agreed. Niran and Jeremy were the bankers, I believe. And we filed to raise $500 million in 2009 when no one was doing anything. We were the largest IPO of the year in 2009. We wound up raising $900 million in a blind pool, externally managed by Starwood Capital. Today, that's a $25 billion company. It's returned 13.2% compounded for the last 12 years. It's originated $94 billion of loans without a loss so far. We have foreclosed, but we've actually repositioned the assets and sold them for huge gains. That's the company that owns L&R, so we will have a first look at a lot of these restructurings through the L&R position. And they also own some affordable housing, which is the gift that keeps on giving. And why did I get into this? Because you asked me a question about what?
Well, I asked you 24 months out, where do you think the best place will be to invest? And
long term, I'm very constructive on residential. I'd still be interested in SFR, single family for rent. We've been in and out. We created Starwood Waypoint Homes, that I merged with Colony Homes, then merged it with Invitation Homes. I sat on the board and I left. But it's a really nice business. It is a business. And it makes a lot of sense, and I think it's a really good business. Right now, home prices are dropping. They will reverse when the Fed lowers rates again. They will stabilize and go up again. So there's not enough housing. Affordable housing, anything to do in affordable housing is interesting. I like what I do in hotels. Buying a beaten down, that hotel in Florida that is the one
Standard?
was the Gansevoort. Oh. No, the Gansevoort. It was a 2011 distressed deal. Credit Suisse had lent them the money. There was a $200 million first from Carlos Slim's bank. Tony Slim is the son in Bursa. There was a $200 million second that Credit Suisse had and $75 million of equity. We bought the $200 million second for $30 million. Foreclosed out the equity. We're in the asset for $230. It was only making like $1 million as the Gansevoort. This year, that hotel will make $76 million. And we sold all the condos. So for 3 times what we thought they would trade for. We modeled them at $670 a foot, and they sold it almost $2,000 a foot. It was a really good deal. But that's because of what we did with the asset. So you can do that in any market. This is a really good time to buy really good real estate that you can fix up at really cheap prices. So if you can find, we just bought the St. Regis in Kauai. It will open in February as the One Hotel Honolulu Bay. This is in Princeville. It'll be the flagship for the brand. It's going to be, the rates we're getting are 3 times what we underwrote. We're going to open at $2,000 a night. We underwrote $800 a night. Right. It's crazy. Makes up for a lot of cost overruns. Right. So we'll see. I mean, the hotel market's fascinating to me because rates are really high.
So I just have one question left. I always ask everybody that I interview, what keeps you up at night?
Just about everything. Actually, I mean, today, probably because I'm getting older, the absolute awful politics of the country, the 2 extremes dominating the conversation, the moderates in the middle having no voice, and the fact that the nation's making no progress on really critical issues facing the people. And we have to listen to an ex-president dining with a Nazi is just absolutely abhorrent. And the fact that nobody will condemn the guy, I mean, it's unbelievable. And I'm Jewish. I knew he was good for Israel, but there's no place. The reason you see what you see in the country today is the KKK used to have to hide in the woods and operate at night. Now they're on Park Avenue being welcomed into the president's home. That is just absurd. And the left is no better. So the left has its own issues with.
So how would you handicap DeSantis as the next president compared to Trump or Biden or anybody else?
I'm going for Glenn Youngkin. I hope the two nuts kill each other and we wind up with a moderate in the White House.
Right.
The nation needs, the nation is independent. 43% of America is independent today. There's only 28% Democrats and 26 or 5 Republicans, and there's nobody in the middle. Most of my generation and my kids are fiscally, they're socially liberal. The nation is socially liberal. And then are you fiscal conservative or fiscal socialist? Most people are fiscal conservatives. That kind of defines the moderate today, and we don't have a candidate. How to get that candidate on the ballot would just be breathtaking for this nation. We really need to heal. And there's so many things we can do if we stick together. It'd be such a breath of fresh air because you don't want to, I don't even watch anything on TV anymore except for White Lotus.
Yellowstone.
I mean, I can't watch the news. I can't even watch. I watched Cheddar this morning. What the hell is Cheddar News? But I decided to watch that instead of CNN and Fox. I don't even know what Cheddar is, but I watched it. What is Cheddar? I don't know. I was in New York and I saw the news station. Thanks for having me, guys.
Thanks, Barry.